So I think that we are going to see the availability of debt be quite strong flowing into Canada, especially when we look at by subsector and by region. When we look at multifamily, for example, I think that there is going to be lots of debt available, and I think those rates are going to be quite stable. Even if we see the bond yields start to move around a little bit more volatility, I think we're going to see the spreads even out that cost a fair bit. So I think we're going to see relatively stable interest rates. Even if things move up a little bit, I don't think it's going to be any sizable increase. And with that, I think, therefore, we're going to see some stable cap rates.
So we've seen tremendous interest from capital providers for debt for real estate, and that trend hasn't really changed. 2018 was a strong year, lots of availability. Again, in the apartment space, CMHC, insured financing is readily available. We've seen pricing very competitive. I'd say probably middle to low end of the range in terms of its long-term historical trends in terms of spread. And that's a good thing for the multi-res sector. We've seen bond rates, we saw in the last part of 2018, we saw some movements up. There was, obviously discussions by central bankers about raising short-term rates. That's cooled a little bit as we got into Q1 of 2019. I expect that what we'll see continued strong interest from lenders on providing capital to real estate, and I would expect that rates and overall pricing will remain fairly competitive for at least 2019.
We have not seen any change in the availability of debt in the market this year. All of the traditional lenders are there, the banks, the life cos, the pension plans. We've even seen some foreign lenders from Europe come into the market. So there's plenty of availability and liquidity of debt. Interest rates, of course, have remained stable. The only thing that we've seen, frankly, is a bit of expansion in the credit spreads of about 20 to 40 basis points. So we really don't expect to see any impact cap rates due to the availability of the cost of debt in 2019. With respect to cap rates, we also think it's a bit of a myth that if interest rates were to go up, that cap rates would automatically expand. Often increases in interest rates are due to better economic environment where our operating properties will do better and produce higher NOIs and therefore be able to continue to enjoy the cap rates that they enjoy today.
So the question is, what are our expectations for the balance of 2019 on interest rates and on spreads impacting overall interest rates, and how do those expectations impact potentially on cap rates? So as we saw late in Q4 of 2018, we did see some movement upward in both short, medium, and long-term rates. Most of that movement was caused by and was a function of increases in spreads. And so over 2018, if you were thinking about 10-year financing, debt financing, and you were a borrower, you would have seen your cost of financing increase by almost 100 basis points, which was largely fueled by increases in spreads. I think 9 basis points, give or take, in 2018 was a function of movement upward in the Government of Canada 10-year bond rate, and the other 90 or so basis points in that 100 basis points movement was caused by an increase in spreads. And so what does that tell us? It tells us that, at least from the debt capital markets perspective, investors and issuers were expecting further movement upwards in overall interest rates. Having said that, what's happened in the first 2 months or so of 2019 is that those spreads have started to compress. And so we've seen at least half of that 90 basis point movement upward compress in the first 2 months of this year. So the gap, if you will, has been muted by almost 50 basis points year to date in what the cost of a 10-year bond might cost an issuer today versus what it would have cost in mid-December of last year, which is all great news, certainly for borrowers, and I think it's also perhaps good news for issuers because it's brought some stability back to the debt capital markets. What it means with respect to spreads or even cap rates on real estate is clearly if your cost of financing is becoming less expensive. Intuitively, you would expect cap rates to compress further. I'm not so sure we're going to see cap rates moving or compressing necessarily because of interest rate movement, but perhaps more so because of continued demand for higher quality real estate. What had happened in the third and fourth quarters of last year was we did see a movement down in the actual velocity of deals or the number of transactions that were taking place, primarily because there was an expectations gap between vendors of real estate and purchasers, those purchasers expecting to finance their purchases with higher yielding and higher cost debt. Clearly, with the compression that we've experienced most recently, that expectation gap should be narrowed, and we should hopefully see stability in values. We should see further compression in cap rates and presumably marginally or nominally higher values for most classes of real estate, at least in Canada. And so we don't expect to see any real movement upward, at least in Government of Canada bond rates. And over the balance of 2019, I think it's safe to say, assuming that markets continue to be stabilized, that spreads on all bond yields we would expect to see further compression in. So, in fact, it may be less expensive and less onerous to borrow money in Q3 and Q4 of 2019 than it may be today.